Welcome to the roundtable. I'm Tom Nunemaker with our guest Ali. And today, before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulator trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, Ali, welcome. I'm going to stop sharing my desktop and turn the ball over to you. So this is your first time on the roundtable, and welcome. I think we've crossed paths a few years ago in the Sheridan community, and it's nice to talk to you and have you present to our group. So welcome.
Thank you so much. Appreciate it, and glad to be here. All right.
So you should be able to share your desktop now.
I'm not seeing anything yet.
Try going, let's see, Control-Alt-D if you're on Windows.
Okay.
Oh, there we go. Okay, I see a PowerPoint.
All right, great. Okay, welcome everyone. Today, what I wanted to do is basically talk about how I trade options, and I pretty much exclusively trade and invest with options, but I'm definitely have a directional opinion, use a directional trading systems in order to assist me in my trade. So what we're going to cover is basically what I normally do, looking at the market, and just some general concepts to go over, and hopefully this will be helpful to folks. First, just a quick disclaimer. Again, everything, as Tom mentioned, is for informational purposes, and there's no advice that's taking place here. There's also, we're going to take a look at some simulated trades, and there's no guarantee in the future that you're going to see the same performance you've seen in the past, and a lot of the simulated trades are based on, a lot of the trades you're going to see is based on simulated performances, and therefore not all of them. Some of them actually do take commission and slippage into consideration. With that said, just a quick background about myself. And by the way, Tom, if there are any questions that you want to bring to my attention, I'll be more than happy to cover those. Or if people want to wait until the end to go over the questions, I'm fine with that as well.
Okay, sure.
Just a quick background. I started in the markets back in 1987. It's a long story. I don't want to get into it, but basically my first stock trade was a week before the 87 crash, and which is a kind of an interesting story right there. But I've been fairly active investing and trading with options, almost exclusively options, since 2001. I've served as the assistant coach for Charles Cottle. Some of you know him. He's a risk doctor. And I currently trade my own account and manage family account. I do some limited consulting and mentoring work as well. I do have a private Google group that if you're interested in joining, just shoot me an email. I can add you. We typically talk about market conditions and option trades in that group. The overall trading approach that I take with the market, as I mentioned, has pretty much everything I do has a directional bias. I rarely place any trade on that doesn't incorporate one of my directional trading systems into it. That includes the sideways strategies that I trade, with a lot of people refer to as income strategies. Actually, personally, I don't like to use that term income, but because a lot of times it could be misleading to beginning traders. But essentially, with every type of trade that I do, it's influenced by my directional systems. I typically trade I've 4 different time frames that I'm focused on: 30-minute chart, daily, weekly, and monthly. I have systems that trading systems that are applicable to those various time frames. My most common time frames, however, are daily and weekly, which I based most of my trading decisions on. And just a clarification, when I refer to, when I talk about short term, I'm typically talking about trades that last for in duration of days, 2 days, 3 days, 4 days, etc. And when I talk about medium term, I'm typically talking about trades that last for weeks. And long-term trades for me are the ones that last for months. Most of my trading methodology is basically mechanical. I have mechanical entry and exit rules. I do use discretion, but the way I describe it is I'm discretionary within a mechanical framework. That means my systems tell me when it's time to buy or sell. The exact timing, whether I want to delay it a bit, wait for a confirmation, or etc., is something that I use discretion and judgment about. And what that also means or implies is that if my trading system is telling me, my directional trading system is telling me this is not the time to be short or long or in a market neutral position, then I wouldn't be in it. The trading systems that I have fall into these various categories. There's mean reversion systems, which take advantage of short-term reversals. There's momentum systems that I have, which take advantage of strong moves, either up or down. You can call it short-term bursts. As an example, the one we had yesterday. Trend-following systems are the ones that look to find a trending market and take advantage of it. And I'm also highly focused on volatility, contraction, and expansion because being an option trader, that's very relevant to me. And also, I'm also interested in very much what I call trend range cycles. And this is where I want to be able to know when the market is more likely to be range bound versus when it's more likely to be trending. And because that's also very relevant to the type of strategies I want to implement, whether they're directional trades or sideways trades or breakout trades, etc. The option structures that I use are all your typical type of structures that people are commonly aware of. I trade everything from the butterfly family. I call those wing spreads. So those are butterflies, condors, broken wing butterflies. I trade them both short and long. Calendars and diagonals, vertical spreads, and even calls and puts. When the market environment's right, you can make a good deal of money just buying calls or puts. And of course, I'm also a big seller of options as well, which I do all the time. My primary focus is, for the most part, I trade a lot more butterflies and diagonals than anything else. But the other ones I'm pretty active as well. My decision-making process for entry and exits is, for all option trades that I do is, as I've mentioned before, is based on my analysis of the movement of the price itself, the volatility analysis, and of course there's money management rules. So what that implies is that I'm not, for example, putting trades on because it's 45 days before expiration. I'm always putting a trade on because there is a signal from one of my systems or and sometimes it's a very clear, discrete signal saying here's the time. Other times it's a window, meaning that it's a clear signal for entering versus a signal that says stay away from this type of position. All my trading systems are based on what I call market first principles. So we get into, this is a kind of common thing that when people talk about directional systems, you have typically they're either indicator based or some type of a price pattern based where people say, well, when this moving average crosses that or when this stochastic or MACD does this, I do this, etc. What I do is I start out with what I call these market principles as the foundation for everything that I do. And what I mean by these principles are these are patterns that I have noticed work in the market for a very long time. They have either always have worked, or they've been working for decades. For the most part, these patterns can be quantified, and the other key thing is that they're not dependent on any magic indicator or a magic setting for that indicator. So, for example, if if someone says, well, I'm using this particular version of stochastic, and if you just set the parameters to this specific setting, it's worked beautifully, perfectly. Those are the kind of things that don't interest me unless if I vary the parameters on that indicator and substitute other similar indicators for it, it still works. So these are what I call the principles, things that hold true, and these are kind of concepts that just simply seem to work. And we'll talk about some of those, so we'll get more clear on what I mean. So my focus has been on the equity markets and the indexes for the most part. Commodities, Forex, other instruments work a little bit differently, trade a little bit differently. Some of the principles do apply to them, but as I mentioned, my focus has been on the equity markets, which is primarily indexes, but also individual stocks as well. Two key principles that I have noticed that seem to show an edge in the market is the concept of mean reversion and the concept of a trend. Now, these are just two out of over a dozen that I've identified. And when you test these concepts, and like I said, I'm not basing this on just my personal opinion of what I think would work. I've actually taken the time to go back and test this stuff in the markets, and I've been trading it real time for many years. And what I've noticed is that mean reversion has a strong tendency in the equity markets, and it works very well. And so does trend. Now, the two seem to be somewhat contradictory. People say, you come across where people say, well, I'm a trend follower. So if the market's up, I'm going with it. The market's down, I'm going with that. Other traders will categorize themselves as what is the word I'm looking for? Counter trend traders, where if the market's up, they're looking to short. If the market's down, they're looking to go long. And they always seem to be butting head or having an argument with one another. So the question is, which one is right? How can both of these principles be active in the markets? Contrarians, that was the word I was looking for. So people say, I'm a contrarian. So they're always looking to fade the market. So how could both of these principles be right? Where I think people make the mistake is that they're mixed time frames with one another. What I have noticed is that the notion of mean reversion works a lot better when you're measuring it in the shorter time frame, and that for me is measured in days. And the notion of trend following works a lot better when you're looking at a higher time frames. Weeklies work better, and monthlies even look even more better. So this is where people run into problem. And just to give you I'll go a little bit deeper into this, but just to give you a concept in terms of mean reversion, this is the green line is an equity curve of a very simple system that simply buys the 20-day highs. So this is a simple breakout system that the turtles follow, that's been around for a long time, where every time the market makes a 20-day high, you buy. Now, I didn't put any kind of a fancy exit strategies on it because this was just a proof of concept to test the entry and how well does that entry do. And I think my exit is simply exiting 20 days later. So I'm not testing any exit strategies, just getting it. And I believe this is an older chart, but the concept's still applicable. This is one of the indexes. I think it's the S&P. So as you can tell, is that it's done okay. It's been profitable, but it's dramatically underperformed the market, and this is going back from 2002 until 2014 test period. So here's the case where we do the opposite. We're buying the 20-day lows. And there's no filters in place, meaning that we're doing the same thing in the bear market and the bull market. But as you can see that there's a dramatic difference in terms of performance in terms of buying the 20-day low versus the high. And just to give you a perspective, here's buying a 20-day high, here's buying the 20-day low. Now, these are not systems I would actually trade. These are more proof of concept in terms of trying to determine what works versus what doesn't work. And I have run different variations of the same concept over and over under different markets, different indexes, different time frames, and they all pretty much conclude the same thing, that over the shorter time frame to a medium time frame, buying the dips works a lot better. So let's look at something else. Here's a short-term mean reversion system applied to the daily chart of SPX. This is, again, a proof of concept, not a good trading system, but a mechanical way where, and I think I based this on a short-term RSI, where the system simply goes long as soon as there is a oversold condition based on the RSI, 2-period RSI reading, and when there's a bounce, it exits and then goes short if there's an oversold condition. It just does that mechanically. As you can see that it's done relatively well. It's been profitable. It's been ups and downs, and at least during this last year or so, it's shown some drawdown, but at least it's been very profitable. Now, if we take this exact same system, which is applied to the daily chart, and apply it to the monthly chart, this is what you get. So this is exact same mean reversion system where it's looking to buy the dips and sell the rallies. And it's done horribly. And the same pattern is seen on, as I mentioned, on the other indexes. This is SPX, but NDX and Russell and anything that usually represents a basket of stocks pretty much shows the same pattern. So this basically validates, and this is where it throws a lot of people off with regards to this concept that, which I was mentioning here, is that when you are looking at a mean reversion approach, you want to be focused on a shorter term, and if you're more focused on the longer term, you want to pay attention to the trend and not try to fade it, which is very important. I had friends back in 2013, they kept looking at the monthly chart of S&P and saying, well, this market's gone up too far, and coming up with all sorts of reasons why the market is way overbought and shouldn't keep going higher, and we kept going higher. So that's the kind of thing you don't want to do with the longer term trend. Here's an example of looking at a long-term trend, basically focusing on a 30-week moving average on the weekly chart. And as you can see, the concept of a trend is a lot more smoother and visible. I've color-coded the line as red for down and blue for up. And yes, there are whipsaws. There are periods of time where the market looks like it's going to trend lower and then it reverses, goes back up. But if someone would actually apply this, they could, by definition, stay out of every bear market. You will subject yourself to some whipsaws, obviously, but by definition, you will never be caught in a 50%, 40%, 30%, whatever decline in an index in this kind of using this kind of a system. Here's an example of a trend following system using the 10-60 EMA crossover. So when the 10 moving average crosses 60, you go long. When it crosses below it, you exit. So it's a long only system. And you notice when we apply this to the weekly chart we'll see that it has a very high probability of wins, and the performance is actually a lot better than buy and hold. Here are the actual trades. Of course, this is, again, a little bit outdated, but they're not huge number of trades. It doesn't get you in and out that often, but as you can see, you'll see that there are fairly substantial large winners and and one small loser in this case for this particular system. Again, verifying that following the longer-term trend of the market is actually quite beneficial, even if you're a short-term trader. I'll give you an example of that. So here's how I create trading systems, and as I mentioned, I'm focused on what those market concepts are that seem to hold true. And once I have those, I create a framework around it, and then my systems basically have to fit into that framework. And this is what tells me that this system is going to be relatively good or has a better chance of performing well versus breaking down. So here's an example to clarify my terminology, what I mean by a framework versus a system. The principles or these concepts, such as mean reversion in the shorter term, trend following in the longer term, and like I said, there's over a dozen of those that I've identified, help me create a framework, if you will. So for example, if I take two principles, which is short-term mean reversion and long-term trend following, that leads me into a framework of wanting to build systems that buy pullbacks in bull markets. So I'm essentially aligning myself with the longer-term trend, but taking advantage of the concept of mean reversion on the shorter time frame, and vice versa in bear markets. And then once I have this framework, then I can build systems with specific rules that have entry and exit rules that basically are based on that framework. So here's an example of a system, and I have a lot of these mean reversion systems, but conceptually they're pretty much looking at the same thing. So here's an example. You take you go long when the 2-period, 3-period, or a 4-period RSI is below level 10, 15, or 20. And price has closed below, has closed lower for at least 2, 3, or 4 days in a row. And price is also closing below its 4, 5, or 6 simple period moving average. And price happens to be above one of the longer-term moving averages. Now, the reason I didn't put any specifics, I said 2, 3, or 4, 10, 15, or 20, 5, 4, 5, and 6, is to demonstrate to you that if I had given you one specific setting and it's only that magic setting that worked, this system would be worthless. And it's more likely that it may work sometimes and fail 2 months later. But if I give you a range of parameters and all of them show profit on a long period of time over the market, then that approach is a lot more likely to be what's called robust and work. And therefore, you can pretty much plug in any one of these parameters and test any one combination. Now, some would perform better than others. Some will do better in this market versus that market. But overall, they should all be a positive expectancy set of systems. And the exit is basically as soon as the price closes above the simple moving average, you exit this long position or you go back into a neutral status. So what we did was I had a little project, and this goes back about 5 years ago, where me and a group of friends and associates said, let's go take a mean reversion system like this, a simple short-term system, and see how well does it work if we traded options, meaning that we were not buying and selling the underlying, we're actually trading options. And we tested just simply buying long puts and calls, or trading credits and trading credit spreads and trading debit spreads. We had 3 different tests going on, and the test period we had as much as data we could get went from 2005 until 2010. So it was a 5-year test period, which was great because it included a sideways market, included bear markets, and included a bull market in there. So we were able to see the performance of our strategy for a 5-year period that included all sorts of different market conditions. This particular equity curve for that test was just simply buying the second strike in the money call or put, and it was a variation of the system here. We went long, and the opposite was we went short, the opposite of these rules. When the market was overbought, we went in a bear market, we went short. The one thing we did do is we scaled into the position, so we would buy, let's say, one contract, and if the market went lower, we added to that position. The maximum lot that we traded was 10 lots. So this was SPY maximum of 10 contracts. The majority of the signals or trades were exited before we even got to the 10-lot position. So for example, if the market dips one day, we buy the one lot, and if it immediately rallies and exits and gives the exit signal, we're out of that one lot position. On average, we had about maybe, I want to say, 3 or 4 lot position on, and the average cost of the options around those times, of course, it varied from time to time, but it was around maybe $3 or $5 in that range. So with that kind of a money allocation, this showed about a $17,000 return. And let's say if we got about 5 contracts, so about 2,500 average of margin or money that we were using for this. And we did subtract commission, and we did subtract, I think, $1 or $1.50 a contract, and we also subtracted 5 cents for slippage, 5 cents on the way in, 5 cents on the way out. And this was the performance we got with just naked buying longs and puts. The same test on using credit spreads, which is, I think it was 3 or 4 wide on SPY, selling one strike out of the money put for the bullish trade and one strike out of the money call for the bearish trade. What we noticed was that the equity curve was a lot smoother, as you would expect, but the returns were dramatically less. And this, again, trading at one lot, up to 10 lot position. So the return was around 3,500 for the course of the 10 years. Now, one thing I do want to point out is that you may not be able to see it carefully enough, but there was a period of time for a number of months that the system was not performing dramatically. It had some winners, it had some losers, etc. So, and that is true for every trading approach or system that you would trade. And it's very easy to kind of see these kind of numbers and say, wow, that seems like the holy grail if I only did that. Yeah, the problem is most people don't have the psychology to follow with their rules and stick with the system. They typically, if they're trading an approach for a few weeks or a few months and it's not giving them enough of a reward, they'll abandon and move to something else. So I think psychology plays a huge role in these things. Just to show you in terms of from a pure mathematics of it, not taking psychology into consideration, the concepts worked. And again, I myself have been very actively using these systems with very good results for that time frame since then. So how do you apply these directional systems to option trading? As I mentioned, you could just simply trade pure directional trading. You can either buy premium or short premium, doing credit spreads, buying vertical spreads. And you can either take advantage of short-term swings, especially with these mean reversion systems. Now, one big problem that a lot of mean reversion traders have that don't use options is they don't know how to control the risk. Because one of the principles of mean reversion is that if you try to stop yourself out, so let's say the S&P drops, 3 days in a row, and great, so you're buying it, where do you put your stop? Now, if you actually test any kind of a stop setting, you'll notice that you start taking away the system's performance. And by the way, let me add that mean reversion trading is a high probability trading system. Even though we're buying puts and calls, the win rate is in excess of 70-75%, I think, for the specific system. And I have systems that perform even much higher than that in terms of 85-90% probability of success. So one problem that people that don't use options have is risk management. The good thing about options and using options is that when you're using a defined risk strategy, whether it's a long call or put, you have a built-in stop. So you really don't have to worry about that, assuming you've sized your position carefully. Now, there are ways of introducing stops into these mean reversion systems that don't degrade the performance as much. And however, there's still going to be some level of degradation if you introduce stops. So there's a trade-off involved. But the point is that you can trade directionally on a short-term basis and do very well, even if you're just using puts and calls. The other thing that I think a lot of people miss out on, a lot of the retail traders, is attempting to catch major trends in the market using long options. And the market goes down differently than it goes up. Everybody knows that. But irrespective, catching big moves in the market that may last for weeks or months, that could be quite profitable. I had a chat with Jack Schwager, which I don't know how many people heard of, but he's the author of the Market Wizards book. And I asked him, of all the various option traders, so what he does is he goes around interviewing the top traders in the world. He has many books out. If you haven't read it, I highly recommend his books. He pretty much just interviewed one option trader in his first book, which was Tony Saliba, who had incredible performance. He was a market maker. But the rest of his books are primarily hedge fund managers and other private traders, et cetera, that they use options, but they're not primarily just option traders. So I asked him, I said, do you know option traders that are ultra successful, and what do? Are they primarily the buyer of premium or seller of premium? And he said, the answer he gave me was actually quite surprising. He said, now he doesn't know all the successful option traders, but of the ones he knows, they're all buyers of premium. They're all buyers of premium. And not necessarily short-term traders, not the ones that are looking to make a quick buck buying weekly options, but the ones that come in and put fairly large size on, looking at capturing big positions with enough time. So that's a undercapitalized portion of what people can do with options, which I think underutilized, I should say, what people can do with options, which I think is not done enough, in my opinion. Now, of course, you can apply these various directional systems that I mentioned to your non-directional trading as well, to the income strategies. And these are the different things you can do with them that I do with them is, number one, you can better time your entries. You can better determine your adjustment points based on technical levels and various signals versus being just things because the market moved down 20 points to reach the break even. I'm doing it. You can base things on other things. You can determine better exit points. So the exit point doesn't necessarily have to be, okay, once I have X percentage, then I'm out. it may be that you may have to trade or exit sooner because the market is shifting or changing conditions. You're getting a signal in the opposite direction, for example. Strike selection, days till expiration is very helpful, or helps in that regards. The other thing is that position sizing and scaling decisions. How big do you want to put the position on? Sometimes because not everything is lined up in terms of what I call technical probabilities, I don't want to be fully sized in a particular position. And as far as the scaling in, that's also a big factor depending on market conditions. I give you one example of this, of scaling in that if we're in a raging bull market, I'm typically a lot more aggressive getting into my bullish positions a lot quicker, whether it's a position that has a bullish lean, it's a market neutral position that has a bullish lean, it's a pure directional trade, doesn't matter. But if I'm interested in trading on the bullish side because let's say the market got deeply oversold, I'm typically scaling in slower in a bear market because in bear markets there's a higher volatility and a higher probability the market will go lower. So this plays a big factor in terms of how I size and how I scale. And of course, the big factor is there's also times where it's not time to trade a specific strategy because the market is showing signals that it's about to make a big move either up or down, and you may want to wait. So this is also a big factor. Let me pause, and I don't have too many more slides left, just a few more, but I want to pause, make sure that there's no major questions that people need answered at this point. Before
there were a couple questions. John asked, do you rely on Charles diametrics, I guess, approach? Right.
No, I don't. Charles has its own way of doing technical analysis. It's based on drawing trend lines and having them be symmetrical and create these diamond-shaped structures on the price chart, and he's looking for support resistance levels and price projections. I don't. Like I said, most of my trading is based on stuff that I can quantify. And when it comes to there's certain side of technical trading that's subjective. That doesn't mean it's wrong or it doesn't work. It's just too subjective, and because I can't test it and quantify it, it doesn't give me the confidence to trade it. And just a quick story about myself is when I first started trading and wanting to put directional opinion into my trading, because that's actually how I started with options, being a directional trader. I was really, really bad at it, meaning that I was, I want to say wrong 70% of the time, and meaning worse than random. And now over time, I started asking the question saying, how can I do better? What is this? So, and right now, I'm more like 85% of probability. In fact, in the group that I mentioned, every time I see a directional edge in the market, whether it's short-term, medium-term, I typically post it to the members of the group. And if you go back and look at my history, you'll see that probably it's around 85-90% success rate with what I've been putting in there. And I believe what did that for me was throwing away a lot of the subjective stuff that was not giving me the confidence and being able to take the approach which I've outlined here.
Okay. Yeah, there's a few more. Peter asked for your email address. I think that's on the slides, and I'll post that in the recording. Dennis asked, what are you using for these back tests?
For these back tests, I've used a product which unfortunately no longer available for purchase. It was called Wealth Lab Pro. However, I've started switching over to Aeromir broker, which is a very inexpensive product. It's very powerful, but you can also use TradeStation and others. It does require a bit of a scripting or programming to be able to code these various entry-exit rules and test things, but the product that I've used in the past was WealthLab.
Okay, and Chuck said, neat stuff. In backtesting the long SPY options, what DTE options were used, and how long did you work with Charles Cottle? So he has two questions.
Right. So the long short positions, the long short calls was 1 month out. The rules were pretty mechanical. We had to make some very mechanical rules so then the whole group knows exactly what to follow. So it was buying an option that at least had 30 days, the first option that had 30 days in it. And we would buy the second strike in the money. So SPY was at 119.20. We would buy the 118 call with at least 30 days. The first option that at least had 30 days in it. And same goes with the puts, just reverse the rules. As far as my working with Charles Cottle, he's been a mentor and a good friend for many years. And I believe the work that I did with him goes back, actually, it's not recent, about 3 years ago that I was assisting him in one of the mentoring programs that he ran for. I think he ran for maybe about 6 months to a year at the time.
Okay, and somebody was asking for a link to that group. I guess it'll be in the slides, and I'll also put it on the recording. Yes,
it'll be in the slide, and as I mentioned, you can always send me an email, which is also in the slide, and I can send you an invite to the group as well.
Okay, I think that's it for the questions. Richard asked, will I email a link to the recording? Yes, I will. You can also log into the member site and download the recording in the library too.
Right, great. So there's a couple of things I wanted to cover in terms of what are some of the myths out there versus reality about directional trading. These are things that I hear common. I mean, especially for newer clients that I have that are just trying to learn how to apply directional analysis to their options trading. I encounter this, is that they're always looking. One myth is that you can always reliably predict markets' next move all the time, meaning that look at your indicators, look at your charts. What is the market going to do tomorrow or the next 3 days or whatever the time frame might be? The reality of it is that it doesn't work that way, that you should think of the market as random most of the time, but demonstrating or showing edges from at specific points in time, which they appear and disappear. So if you start telling yourself that you can predict where the market is going, especially when you get good at this and you notice that, you keep hitting these ones and twos and over, you're getting the market direction, or you might start thinking that you're going to be doing that all the time, which is not true. So you want to be very careful. It's good not to have an opinion most of the time, but have an opinion when there's an edge. The other thing is predictive versus reactive. Sometimes people think that you have to be able to predict the market's next move in order to make money trading directionally. The reality of it is that you don't have to even do that. There's a lot of directional traders that simply follow or react to what the market is doing. And because they're using proper money management, because they have a good risk-reward ratio, they're successful. And actually, as an example of a reactive trading, I just wanted to real quick show you guys an article that was published a few years ago by Steve Lentz from OptionView. And what he did was he tested a basic covered call strategy that, included some bull market and some bear market, 2007 and 8 type of a market condition. And the question was, should you do a covered call selling in the money, at the money, or out of the money options? And what he showed was that owning the equity by itself had a 31% decline for that period of time. But if you did an at-the-money covered call, obviously that provided some type of a hedge for you, so your losses were a lot smaller. Then he applied a very simple directional trading rule where he said, well, we're just going to look at two moving averages, the two popular ones, 50 and 200. And what we're going to do is we're going to adjust our strike, the one we use to sell the option, depending on where the market is in relation to these two lines. So if the market was above the two moving averages, he would sell out of the money off calls because it was more bullish. If it was between the two lines, he would sell at the money options. And if the market was below and I think this is wrong, you should say in the money, but if the option was below the 50 and 200, he was selling in the money calls, which is a more defensive position. So notice that there's no prediction in what he was testing. He's not trying to predict where the market's going next. He's simply altering his strike selection depending on the market condition. And the results were what he called the adjusted covered call was actually flat, meaning that it outperformed the at-the-money call selling versus not doing anything at all. So by just simply making that adjustment to his strike selection, he was able to perform a lot better. And this is just an example that I wanted to show that you don't have to be a guru in knowing where the market's going next in order to take advantage of some basic concepts like that. The next myth, or I should say mindset, is that people think that if they have a directional edge, so for example, if we look at the market, say, well, it's oversold, we're in a bull market, I'm going to buy a call. And you buy the call and you're wrong, and then you do the next trade, again you're wrong, you go, so well, this doesn't work. Well, the reality of it is that all the directional edges are also based on probabilities, not certainty. So that means that if you're even right 70, 80, 90% of the time, you're still going to be wrong 10, 20, 30% of the time. And in fact, if you have a system that's right even 80% of the time, the odds of getting 2 or 3 losers in a row is not that small. They will occur. So, and this is where a lot of people fail, is that they give up and think it doesn't work. The other thing is that there's a lot of books and opinion about technical analysis out there, and based on what I've researched and what I've seen, some of it used to work, some of it never worked. But irrespective, there's a lot of stuff out there that doesn't work for whatever reason. It never worked or used to work. One example of something that used to work was the breakout system, where the turtles based their trading on. That does not work on the indexes very well. So the other thing that's a very common misconception, and the reason I listed it is because you're hearing it these days, which is, well, market rising on low volume is bearish. When you actually test this out, it has no edge, meaning that market always falls on higher volume, always rises on lower volume, and you can't tell based on that whether it's going to continue to go higher or lower. In fact, I've noticed in some occasions that a high volume when the market goes up is actually not good. So these are things that you see out there that have no basis. You want to be very careful. History versus future. This is a common thing that people say that don't like technical analysis. Say that, well, technical analysis just simply happens to show what happened in the past. It has nothing to do with the future. Well, that is true, but that doesn't mean. But the reality of it is there's certain patterns that you can detect in the market that repeat themselves all the time that are predicted. And the example of that is the mean reversion concept we talked about. And the other myth that is out there is that I'm just not good at this stuff. You know, I've tried, I'm not good at it. But the reality is that once you learn how the markets really work, you understand the principles as the foundation, is what I call the first principles, you will actually get better. And I am the proof of that. That, you know, I went through the same process, like I said, started out being really, really bad at it. So it's not that you're born with it, you can actually get good at it. The final slide I have is just the path forward. You know, a lot of times is, again, based on personal experience, you can hand out as many systems to people as you like. It doesn't matter. I can give away my best directional system to people, say, here you go for free, go trade it. The reality of it is that most people will not succeed in that approach, simply because when you're given something and you don't have the confidence in it, you have a tendency to give up and move on to the next thing. So the first thing I would suggest is that whatever if you start thinking in terms of, well, I like to get better at direction, I want to be able to be either incorporated into my non-directional trading or take advantage of some of these directional trades, make sure whatever systems you are beginning to develop, purchase, learn from others, etc., or have a foundation on what I was calling these first principles. And those systems could actually be discretionary. You don't have to be a systematic mechanical trader that takes entry and exit signals like a robot. You could actually be discretionary, but what you want to do is have some rules that you don't violate. So, for example, if the market is in a strong bull market and we just had 4 days of a down move and market is severely oversold, you don't want to come in and say, well, I'm going to go buy puts now because the odds are against you. Now, you could say, I'm not going to buy calls because, you know, I don't want to catch the bounce or whatever else. But you can be discretionary and you can use a bit of a judgment as long as you're doing it in a systematic way and there's a framework around it. This is a key thing, is that you want to develop confidence in your system. And like I was saying, if you get handed an approach, most likely you will abandon it as soon as you take 2 losses in a row. And this is not an easy process. So when you have a system, not only you want to back test it, you want to forward test it as well, and then you want to start with some small trades, and make sure you give yourself enough time over various market conditions to kind of prove to yourself that this works. You want to start studying how the market behaves under different market conditions. This is where a lot of times I see people go wrong, is because they were doing so well back in 2013, and they thought they had the key to the market on how to print money every month. And then the market changes in 2015. It gets very choppy, and then we get this big down moves like we've been seeing. And now what they're doing doesn't work. Well, you want to incorporate that into your trading methodology. You want to be able to there are actually 6 combinations that, if you want to really get technical, there's a bull market, bear market, and a sideways market. And you can apply high volatility and low volatility to every one of those. And those would be your 6 possible combinations. What you want to do is you want to go deeper and deeper into nuances of your system. And actually, I can tell you that the devil's in the details. So once you go deeper and deeper into this stuff, you get better and better at it, because you'll find out, right now we're in a correction mode where there's a high degree of volatility, and the market's been bouncing from the lows. You get a better sense of how your system should behave in this current market, and which approaches work better versus the other. The other key thing is to keeping a journal to keep track of your progress. That's very key. We all have bad memories in terms of what we think we thought 2 weeks ago. It may be completely wrong, so it's very important. And I can tell you that if you are following this process and are persistent about it, you will get better with time. And it's not a matter of weeks. It's really a same goes with option trading. You know, you can't just learn about puts and calls and the Greeks and all of a sudden become the best option trader there is, right? It takes a process. So getting to learn how to be a better directional trader is also a process that takes at least a couple of years, in my opinion. So that's the last slide, and that's it as far as what I had presented. So if there's any questions or anything, or if folks want to look at the charts and have questions about it, I can entertain some of that for a couple of minutes.
Yeah, no questions yet. Maybe you can go back to the slide with your email address, just since you've got it here.
Sure. So it's my first initial, last name @gmail.com.
Easy enough. Well, it looks like no more questions. So thanks very much, Ali. Really appreciate your time and the nice presentation. And for everyone who stayed with us, thanks for staying through the whole thing.
Sure thing.
And Brad Hartman says, thanks, Ali. Nice job. And I think a lot of people agree. So we'll definitely have you back on. So thanks again. No more questions. We'll wrap it up. And we'll see everyone next time. Trade well. And again, thanks, Ali. Really appreciate it.
Of course. Thanks a lot, guys.
All right. Thanks, everyone.
Take care. Bye-bye.